Hello and welcome to Finance with Axel. Today we will talk about diversification and if it's needed, but let's start from the beginning with a definition of diversification. Diversification is the act of investing in different industries, areas, countries, types of financial instruments to reduce the chance that all of these investments will drop in price at the same time. What does this mean in clean English, you might ask? It means, for example, if you want to be invested most diversified, that you would invest worldwide, buying the entire market by its market share, not picking any individual investments which you deem more favorable. Rightfully, you might ask, why the hell should I buy all companies, the good ones, but also the bad ones, where I could achieve much better performance by buying only the good companies? The answer to this question may seem counterintuitive at first, but it makes a lot of sense when you take a closer look and study the subject in depth. In hindsight, it is always easy to say which investment will outperform. However, the same prediction is almost impossible for the future. Even most professional investors often fail to beat the market. And if even the so-called professionals can't outperform the market in the long run, why should you be able to do it? This argument gains even more traction when you take a closer look at the performance of the so-called professionals. One might think that one only has to separate the good apples from the bad ones and then entrust a good fund manager with one's money to outperform the market in the long run. However, this does not work either because past performance is not a reliable indicator for future performance of the respective manager. The outperformance therefore seems to be more due to luck than skill. These findings are in line with the so-called efficient market hypothesis. This theory states that all publicly available information is already reflected in the price. This means that the current price is the best estimate of the future price and that it is impossible to outsmart the market without having insider information, which use is illegal. This still does not explain why diversification is important and good. This is because a random asset or a portfolio that is randomly chosen should have the same expectation as buying the whole market. This statement is true for the time being, but it does not take into account the dispersion. As a general rule, people want to pursue a certain goal with their investments. This usually is retirement planning and/or saving. A few also want to play casino, Wallstreetbets. Only for these group of actors, stock picking and not diversifying makes sense. I will explain why in a second. Diversification is the only free lunch in investing, says the quote attributed to Nobel Prize winner Harry Markowitz. Free lunch in the sense of an improved risk-return ratio of the overall portfolio, which means that you can achieve the same expected return with a smaller dispersion through diversification. If you don't diversify or don't diversify enough, you will usually achieve a worse return compared to the market yield. This is because most stocks perform poorly and underperform, and only a few outliers are responsible for the overall growth. Only a small percentage of assets, about 1 or 2%, beat the market by a huge margin. This means that without diversification, you will either perform worse, often even at a loss, which happens in the majority of cases, or if you are one of the lucky few who happen to pick the right stock, you will outperform the market many times over. If you save for retirement, for example, this result is highly undesirable. Most people would rather achieve results that are less volatile and at the same time more predictable. I will now show you the effects of diversification using a simplified example. The stock market in our model has only 5 stocks. It is not possible to predict in advance which stock will perform well and which will perform poorly. 4 stocks will lose 10% of their value over time, while the 5th will increase 100%. The average return is huge and at 12%. Now you could pursue different strategies. Stock picking would result in you losing 10% of your wealth most of the time, but in one case you would double your money. Most investors would probably prefer to instead achieve the market return, a safe 12%, which can be achieved by diversifying and buying all 5 stocks in equal proportions. That was my explanation of diversification. Let me know in the comments if the video helped you out and if you prefer to play casino or if you diversify. If you like the video, please share it with people who might also get value from it. Please also like for the YouTube algorithm and also consider subscribing with bell notifications on to make sure to not miss any of my future videos. Bye, take care.